Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today for the weekly wrap-up. Graham, what can you tell us about what's been going on in the market this past week?
Yeah, overall, I think we just had maybe a bit of malaise. We're kind of entering those dog days of summer, so maybe a little profit taking. But we did see the S&P index fall for the second straight week. We just saw a mixed inflation report. And I definitely think some concerns about international growth, specifically with China, playing a role in some of the volatility or malaise that we're seeing in the market. So we did see the Nasdaq, the tech-laden Nasdaq, and the Russell down 1.5% to 2%. The S&P edged lower about 0.3%, but we did see 8 of the 11 S&P sectors actually manage, a gain. That to me says we might be seeing a bit of a broadening out in the indices instead of just a few names propelling the market forward or just a few sectors. So the sector that kind of bounced the best, we really saw crude oil, the energy side, up about 3.3%. The other side of the market, say the debt side, from a bond standpoint, really yields bounced up a lot. We saw prices on bonds really under a good bit of pressure. We did see an auction. The government's going to auction bonds from time to time, and they are auctioning some 30-year bonds. And you always look for the appetite in the market to take on that debt. It was a bit soft on the long end of the curve, but we saw a little bit better, maybe fair to good on the 10-year notes that were being auctioned. Consumer prices rose about 0.2% month over month in July. That was pretty in line with expectations, but we did see core CPI climb to about 4.7 year over year. Now, that was the smallest increase that we've seen since October of 21. So even though we've seen an increase, the pace of those increases are diminishing. But on the other side of that, from a producer price standpoint, we did see that gain a bit more than forecast. One interesting note that came out, Stacy, is that we saw the U.S. credit card balances really surpassed $1 trillion. That was the first time ever.
Yeah, that sounds really high, Graham. Is that something that the consumers should be concerned about?
Well, consumer, yeah, because that hits their balance sheet, right? They got to service that debt. That might limit their spending in some other areas. And it could be a precursor in a bigger picture of maybe the consumer starting to be stressed. So they're leaning towards these debt instruments to fund what they don't have in cash and in savings. But we didn't see it as a widespread stress at this particular point, but definitely something we want to keep an eye on. Right. But there is higher prices and there's still strong demand from the consumer. If we look at maybe going a little bit into some other numbers like trade deficit shrank in June. We saw more moderate demand while small business confidence did reach some 8-month highs. So we still have enthusiasm out there. The unemployment claims jumped to about a 5-week high. Now, there's not a red flag for that. And I've often mentioned this multiple times is we want to see possibly, and I know the Fed wants to see, they want to see unemployment go up. Unemployment goes up, maybe demand comes down, and inflation can continue to moderate. So we didn't see a red flag there. But we did have Moody's come out, maybe a little late to the party, but they came out anyways and downgraded the outlook or lowered the outlook on 11 U.S. banks, primarily regional. So that's not a huge surprise. Maybe they were a little late to the party on that one, so on and so forth.
What can you tell us about the international market?
Yeah, I think, the big player over there is going to be the large population economies. So say China, China is just really struggling. They got to deal with inflation. They got demand problems. I mean, it's really tumbling over there. Their CPI declined 0.3% because there's just not a demand. Without the demand, you're not going to have maybe that inflation. We just saw exports fall about 14.5%, and their imports shrank about 12.5%. And new loans, get this, that was down 89% month over month. So they're really struggling to get that growth over there. And think about this, Stacy. I mean, they're 1.4 trillion in terms of a population. We're 340 million. So you can imagine their consumption over there. And when they're down and they're not consuming, that can affect the world.
Mm-hmm. Well, I mean, when we consider their lack of growth and inability to get their economy back up and going, how do you think that's going to affect the U.S. and the rest of the world?
Well, we'll have to see. I mean, can we pick up meaning can other parts of the world pick up for the lack of China's consumption? Maybe it's India, 1.4 billion people, right? So they match China roughly in population. So as long as we have some other strong populations that are consuming the goods and services, it's going to put a pressure, but less of a dampening pressure. On the world's economies, but it's certainly good to see everyone consuming all together, right?
Right. Okay. Well, thank you so much, Graham, and thank you to our viewers for joining us today. We hope you have a great week, and we'll be looking forward to seeing you again next week on the weekly wrap up. Have a great day.
Take care.